From a company perspective, as you're starting to scale and raise capital, there are certain scenarios sometimes that you might want to avoid. When you're raising capital and you're much smaller, you're often looking to bring in friends and family and angel investors who aren't writing massive $1 million checks like VCs might. In that scenario, to help keep your cap table clear and make management of those smaller investors easier, you might prefer to have people investing under a certain check size all pooled together into an SPV so that on your cap table, you only have larger investors and then one SPV representing all of the smaller investors. That can certainly make that investor management piece a little bit easier if the individual, typically a lead investor controlling the SPV, then would manage the contact and communication with all of the smaller investors. Even if you did want to keep that relationship with each investor direct to yourself, which you certainly can, having fewer investors on the cap table can be a benefit when looking to raise in the future from larger investors like VCs or private equity firms, as from their perspective, it does mean, there are fewer cooks in the kitchen. You can avoid this if you are offering smaller shareholders non-voting shares and you have a voting trust and they're in a separate share class. So that's another great alternative. It really just depends on, the way that you want to structure and set up your business.